Hi everyone, this is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest. I've been listening to his interviews for a while now over on Chris Martenson on Real Vision TV. Just absolutely fantastic. He's the editor at the High-Tech Strategist newsletter since 1987. He's been covering technology stocks for a very long time. He's a former Barron's Roundtable member, and he's frequently cited on Bloomberg News. Fred Hickey, thank you for joining me.
You're welcome. It's my pleasure.
Now, Fred, I want to get your opinion on valuations for technology companies because, when I watch CNBC or Bloomberg and I have it on for a couple of minutes, they're always saying now is a good time to buy technology stocks, got to buy the dip. So what's your view on technology stocks right now?
Well, it feels a lot. I feel a lot of deja vu. It feels exactly like it did in 2000, which, as you know, was the greatest bubble the country has ever had. And I didn't expect to ever to see the same kind of insanity again. I thought it could only happen once in a lifetime, but I was wrong. And it's unfortunate. I'll give you an example. At the top in 2000, the top five largest tech stocks, and that would include Intel, Cisco, Microsoft, Oracle, and Nokia. Their market valuation was a little over $2 trillion. Now, only 3 of those were in the top 5 then. Today, the 5 largest market caps are all, well, I'll put in quotes, tech names. And it's Amazon, and it's Apple, and it's Google, and it's Facebook, and Microsoft. Their valuation today in total is $4 trillion, or almost 2 times what we were in 2000. Now, inflation we've had inflation since then, but even if you inflation adjust, these valuations for the largest stocks are higher by a significant amount than they were in 2000. Now, people always say, well, back in 2000, I hear it all the time, back in 2000 it was just those bubbles, internet bubble stocks that were crazy. It was the web vans and the pets.com. That was the craziness we have. It's not like that today. We don't have solid companies. And I say, oh, yeah? The money that was lost, the trillions of dollars that was lost in 2000 was not from the web vans and pet.com. That was those small cap companies. It was the largest caps. And they lost on average, well, those big ones lost on average 80%. Nortel, which was a top 10 company in the world at the time, lost 99% of its value over the next 2 years. Sun, EMC, large tech companies who were in the top 20 valuations, all companies in the world, lost 96%. It was a total disaster, and we're doing it again. And if I look back in 2000, as I did, Intel, Microsoft, Cisco, these are real tech companies. Well, I would consider them real. I look at the names that are on the top tech companies now, and I see Facebook. That's an entertainment company, or maybe a time-wasting company. Amazon, consumer company, primarily. It has some, Amazon Web Services, but primarily consumer in a time where the consumer has more debt than ever. When we have 2% savings rates, we've got a giant consumption bubble here. We're spending all kinds of money that we don't have, and Amazon's your number 2 stock. Google, a search company, gets all its money from advertising. Now, I'd say Microsoft is, of course, still a tech company, and so is an Apple. But Apple doesn't grow much anymore. Its unit sales of cell phones were only up 3%. They were just in the process of their so-called super cycle for the 10th anniversary cell phone, and they only shipped in their first full quarter 52 million units. Well, they shipped 60 million of the iPhone 6. So there's no growth there. The smartphone market that was a high grower is now declining year over year. In the first quarter and the fourth quarter, we saw 3% declines year over year in smartphones. Yet, Apple has a market cap of $950 billion. Well, actually, yes, $920 billion. $120 billion. This is a valuation that no one has ever seen before. The highest market cap that we got in 2000 was $600 billion. We've got many of them. We've got Google's $828 billion, Amazon's $853 billion. Like I said, Apple's $920 billion. And these are not cheap stocks. Amazon's selling at 270 times earnings. That's as big or bigger than anything I saw in 2000. So we're having another gigantic bubble. It's not just a tech bubble as it was in 2000. This is some people call it an everything bubble because it's bonds, and it's high yield bonds, and it's real estate, and it's artwork, and it's tech stocks particularly, but also an overall stock market bubble where we saw valuations here on a price to sales basis, market cap to book value, many different measures, either number one or number two, and the other one was in 2000, and then the number two or three, depending on the number you use, is 1929. Well, 1929 and 2000 are two things in common. They both ended in crashes, and they both ended in crashes after interest rates rose. So here we are again. I have to go through it again. I can't buy anything because everything's so darn expensive. I can only do what I did in 2000 and what I did in 2007, which is take small positions against them, put options, keep them small, because I have no idea how high they're going to go. There's no Netflix selling at 271 times earnings, 44 times book value.
Now, Fred, how much do you think the central banks have distorted? Are the central banks the main culprit here, besides just, investors, the trend trading hedge funds, and the high frequency trading algorithms buying something that's already in an uptrend and not caring about valuation? Because the Swiss National Bank, the Swiss Central Bank, I think they're one of the largest shareholders of Facebook, and they're basically a technology hedge fund now with tens of billions of dollars invested in technology shares.
Yes, although they did cut their holdings across the board last quarter, interestingly enough. The Swiss National Bank did. Well, no, it's all down to the Fed again. I mean, it was the Fed that it was easy money by the Fed that drove the NASDAQ tech bubble in 2000. It was easy money. And back then we were talking about, they printed a tiny amount of money, infinitesimal compared to what they did today. It was tens of billions versus, $4 trillion in this latest period. It was the Fed in 2005 when they had a housing bubble. It was the Fed in 2007. We had easy money, easy money, easy money. And in this case, they had to go to 0% rates. And when that didn't work, they had to go to massive quantitative easing. And when they stopped QE1, the stock market took a dive. And then they came in with QE2. When that ended, the stock market took a dive. And then they had to go to infinite QE. And that was enough to propel it to where we are today, which is back in insanity land. So it's always the Fed. We had day traders galore in 2000. We have day traders advertising all the time on CNBC today, too. And they charge several $1,000s for their services. So you can learn how to buy prices. Instead of buying low and selling high, they found the new methodology, which is you buy high and sell higher. And we know how that ends. We just don't know when it ends.
Yeah, I agree.
So
the other thing, Fred, and you can comment on this, that I think is fueling this tech bubble, especially the large cap ones, is this passive investing craze. So with index funds, and it seems that the FAANG stocks are getting all this extra money that they probably wouldn't have gotten in the past because an active value manager would not have kept buying your Facebooks, your Apple, your Amazons, your Netflix, your Googles at those valuations.
Yes, except that's not true, because in 2000, you had fund managers. One fund manager said, "I don't care if he was a major fund manager. Said, I don't care if stocks sell at a gazillion times earnings. I don't care if they're still working, if they're still going higher. I buy them." That's the same mentality today.
Was that guy a value guy, though?
But I agree with you on the ETF part of it, because it's funneling all the money into a small number of names, and the top 5 valued companies are all tech names. it turns out this time. And so, and people don't know what they really own. They just say, well, I'm buying the market. I'm buying the market. The market always goes up. The Fed always has my back. The biggest mistake anyone ever made was selling at the bottom in 2009 or selling at the bottom in 2000. If I just held on and bought all dips, I would have been wonderful. And so I'm just going to buy the market. But what they don't know is they're buying Apple at $920 billion with no growth. They're buying Amazon at 200 and whatever it is times earnings. They're buying Netflix where they burn billions of dollars of cash. They're buying Tesla, which probably has no hope of ever making any money, also burning incredible amounts of money. They own all these things, yet they don't know it. So when the market inevitably declines this time, they're going to own this blob called the S&P 500 or whatever index it is, and they're not going to know what anything is valued at. They're just going to know this just keeps going down and down and down and down. And they can't say, well, it has a great, I'm going to hold on to this because it has a great product, it has great cash. Well, no. It's going to be a blob, an ETF that just keeps going lower and lower and lower. And this sets up for what will be potentially a great panic.
Yeah, I agree about the passive investing. I think it's a bubble and an accident waiting to happen. A lot of these value investors and a lot of value-oriented hedge fund managers have just gotten killed for a while now.
And that was the same case in 2000. Nothing was working except for the technology stocks. Everything. And so at that time, the rest of the market was relatively cheap. That's not the case today, but it's really hard to find any stocks that are really valuable, in terms of what you normally would see as a value stock. But it's the same thing where everyone's being forced into. If you don't, I saw this in 2000. If the fund managers that I was talking to didn't own some of these things, they were underperforming, and they would either get fired or the bonuses would be nothing, and it's almost impossible. The pressures to compete with other people who are willing to pay a gazillion times earnings, it's just enormous. And most people don't have the fortitude to hold off, or they get fired. So even if they do, they don't have a chance to do it.
Yeah, I would completely agree. The professional money managers who aren't privately wealthy on their own, who rely on that paycheck to manage the money, they would rather use the excuse that, well, everyone else was long stocks. So as long as they're safe.
That's why you only hear the Gunlocks, the Paul Tudor Jones, those kinds of people that come out and say this is insane, right? They come out regularly saying this is insane. It's going to be a disaster. But it's only those kinds of people that can withstand it. They have such a reputation. Paul Singers, they have a great reputation, and they won't lose all their funds. But everybody else, trouble.
So you don't think that there's any technology subsectors like 3D printing where there's actually really growth and the valuations are either somewhat reasonable or undervalued at this point? Lesson learned in both 2000 and 2007 and even other periods, 1990s, when I was dealing with that 1990 bear market. Nothing survives. Everything gets killed. Okay, everything gets killed in a downturn. Like I said, the best performing stock was Microsoft, and it was down by 2/3 in 2000. It was the same thing, and in fact, the tech stocks go down even more. So than the overall averages. So as bad, you might have a 50% decline as we saw in the general market in 2000, and similarly in 2000 and 2008. Well, the tech stocks do worse. Everything goes down. So if you're at the second highest valued market in history with bubble stocks going crazy, going up every day, $15 a day on Google and Amazon and Netflix, just higher and higher and higher, not exactly the right time to be trying to buy tech stocks that might be cheap. And I can't even find any, because those 3D printing names, I know them all. Some of them have been bombed out because they had gone crazy a couple of years back when people got all whipped into a frenzy over 3D printing. And so while they look like they're down a lot,
It doesn't mean they're good value here. And the other problem is that these names, the 3D Systems, the Stratasys, and those guys, I don't know if they're going to be the winners. It is very early in that. I've been watching 3D printing for a long time. The company that has probably the best prospects right now is Hewlett-Packard. But you can't buy that either here. So I will be looking to buy things. There's a bunch of companies all over the world that are getting involved in this. And I'll at the appropriate moment, when we've washed out this insane moment, and stocks are down, then I'll reconsider. And there may be new names at that point. But right now, the list of 3D printing companies, and I think 3D printing potentially is one of the very most exciting technologies there is over the next decade. It takes a long time for these things to really make an impact.
Yeah, I completely agree about 3D printing. I mean, the stuff that's coming out of the lab with the news stories and the stuff they're doing in the lab with printing in gel, and all they're combining alloys. We may have graphene in the future, 3D printing. The stuff is really exciting. I mean, it's not hitting the bottom line anytime soon. The 3D printing industry, though, Fred, like a couple years ago, they made some enormous mistakes. They went on acquisition frenzies. They tried to get into retail 3D printing. It was way too soon. The consumer didn't want to pay $600 for a piece of junk 3D printer that took hours to print a tiny little plastic toy that they could buy for $1 or $2.
Correct. Yeah, and a lot of it was prototypes, and it's still to this day. There's no real mass market of 3D type products that are being built. It's all either prototypes or junky things. It's still very immature.
Well, the commercial 3D printing for the modeling, that stuff for companies, to make models of toys or other things, that's, innovative. That's going to save the company from wasting tens of thousands of dollars on plastic injection moldings before they have the prototype down. So that's good. In the commercial scale,
no question.
Yeah, the commercial side, but the retail was a total disaster. I mean, billions of dollars in write-offs.
Right.
So,
yes.
So obviously, our listeners should be very careful about buying technology stocks because I think you've been covering these sectors for so long. After we do have a crash in the technology market, how soon do you think? Maybe a couple years from now, 2 or 3 years, something like that.
Well, what we're looking for is a crack in the market and when the market will break. And once that happens, bear markets don't usually last longer than a couple of years on average. However, this might even be shorter because it's likely the Fed, patting themselves on the back for all the great success in money printing they think they've had, is likely to come back in again. I mean, as of just yesterday, we saw Mario Draghi of the ECB, talking about maybe not ending QE, maybe doing more if the economy needed it before it even stopped. So I think that the biggest problem we've had with these markets is that the central banks have come in and intervened in the cleansing process where you would get valuations down like I used to see, like I was able to take advantage of in the past. Now, in October of 2002, I did buy a bunch of tech names. And again, I had also sold off all my puts, which had done very well. Eventually, it was tough in 1999, but it worked out really well in 2000 to 2002. But I had sold off virtually all puts by October of 2002, and then I bought a bunch of tech names, and that was fine. Some of them were pretty cheap. In 2008, I did the same thing. I got rid of all my puts. I then bought again a list of names, of tech names. One of which was Microsoft, which I held for almost 4 years. But they weren't the kinds of valuations that I normally would see. Normally, you would see single-digit PEs. You would see, dividend yields in the high single digits. Those kinds of things. They keep intervening, and that's a problem. That's a problem for the economy and for the country. And so they're going to do that again. And they'll try, I'm sure, cutting rates. That didn't work in 2006 and 7 when they slashed rates from 5.25% down all the way down to eventually nothing but 1%. All through those cuts, market kept falling. This time they're starting, if it starts from now, less than 2%. So that won't work, I'm sure, and they'll have to do QE. It depends on how how much they do. They'll have to do more than they did last time, and when. I guess at that point, if I see them coming in, I might be buying some tech stocks, but I assume it's not going to be at the kind of values you see at classic bottoms. So I'll be, if they do that, I will be ginger in what I purchase. I'll be, I won't be able to. Back in the old days, I used to tell people in my newsletter, even like in 1987, after the 1987 crash, I was convinced that the economy was fine. And in 1990, which was one of the worst bear markets for techs that we had. And after both of those cases, one time I told my subscribers to sell all the kids' clothes, put everything you can into tech stocks at this point. And then the following time, I said, sell all the kids, because that's how excited I was. Now, I would love that to be the case again, but I know it's not going to happen because the central bankers are enamored of themselves and enamored of quantitative printing, quantitative easing, more money printing. And it never has worked through history, never, ever, ever, ever. It always leads to unintended consequences and further trouble. So that's what we face if they do it again. At some point, they'll take the printing presses away from them because things will have deteriorated so badly, and then maybe we can finally get a real washout where I'll be able to buy. I have no idea when it will happen. So all I can tell you is I will hope to do what I did in 2002 and what I did in 2008, which is at least to be able to make some purchases of tech stocks before the Fed comes in or around the time the Fed indicates that they're going to do another round of QE.
Yeah, I agree that the 5 or 6 largest central banks, and it'll probably be some type of coordinated action between the Fed, the European Central Bank, the Bank of Japan, maybe even the People's Bank of China will be involved in a coordinated action, and they won't allow the asset prices to crash for longer than maybe 6 to 12 months. Even in 2008, it was less than 12 months, right?
Well, it started in October 2007, and it went to 2009, so it was really a year and a half.
Okay.
March of 2009, year and a half.
Okay, yep. 2007 didn't seem like a big crash year, but I remember there were still some assets that were going up, and then the oil price spiked, and then that started the acceleration too, I think, as well.
Yeah, the markets peaked in October, and they fell 50%. So it was a crash. It was epic, and it was in a relatively short period of time. Of as I said, well, I guess 1 year and 5 months.
Yeah, I mean, everything is so leveraged. A lot of the assets are all held with enormous amounts of leverage that I think, the pain point would probably be, my educated guess, is 6 to 12 months before the central bankers panic about, total social unrest, people marching into D.C. with pitchforks, because 2008, we're almost to those levels, with the Occupy Wall Street and the Tea Party crowd.
Absolutely.
And then the money started getting printed.
Correct. Yes. The difference this time is that we have, 50% more debt around the world. So we tried to correct the debt problem by adding massive amounts of more debt. And we certainly didn't have $21+ trillion in deficits here, in debt either here in the U.S. It wasn't even half of that. So you can see what's happened is that we're much more at risk because of the debt levels. And it's at all levels. Before it was mostly consumer and banks were levered. The banks are a little less levered this time around, we think, although I don't know about Deutsche Bank's $50 trillion balance sheet, not balance sheet, but $50 trillion in derivatives. But for the most part, the banks are better off, but everyone else is worse. So the governments have taken on tremendous amounts of debt, and mortgage debt's not quite as high, but consumer debt is, and student loans are, go from $100 billion to $1.5 trillion, and credit card debts are up, and auto loan debts are at records, and so it won't take much for the pain to get really difficult for people.
Yeah, welcome to dystopia. We could spend an hour talking about all the different credit bubbles and asset bubbles that have been created since 2008, either reflated bubbles or brand new ones. So, after there is a bust, what technology industries, in your opinion, actually have, real exciting growth rates that you think long term this industry is going to grow 8%? 10% compounded annual growth rates per year? Is it cybersecurity? I know the valuations on the cybersecurity shares are ridiculous, but
yes.
That seems like an industry where perpetually they have to keep investing more and more money because it's a cat and mouse game between the hackers, whether it's a government hacking another government, a corporation hacking a government hacking a corporation, or retail people like people on Main Street risking getting their identity theft stolen?
No question. That would be an area of great interest. I follow all of those names that are in it right now. The Palo Alto networks, the Proofpoints, the CyberArks, but as you pointed out, insane valuations, and that's the case with any good story area right now. So and that's one of them. I think that's one of the key ones. You mentioned 3D printing. I think that'll be important, and we'll see what's available at that point in time. The cloud is still moving on. People are still there's a lot of businesses that'll continue slowly moving into the cloud, although you're going to get a collapse there because just as we saw in 2000, we had all of that malinvestment that went on. And I was warning people of that in 1999. So we have way too much overcapacity that's been built in fiber optics, and I let it all, internet hosting. And today we have the same thing. We have this great cloud capacity that's been built, and they were based upon, the primary users of the cloud are the newer companies. The older companies, the more established companies, are much slower to move to the cloud. Most of their business is still done on their enterprise systems, but virtually all of the unicorns and all of the companies have gone public. All the money losers, all the people just burning cash like there's no tomorrow, just as they were in 2000, are the customers of the cloud vendors. And those cloud vendors are Amazon and Microsoft and Google and others. And so they're building massive amounts of capacity. Google, for example, tripled their investment in cloud in the first quarter. Microsoft was up 73%. It's just wild kind of building, and they admittedly build in advance of need. And yet their customer bases are, the 120 meal kit companies, none of which make any money, or the 76% of companies that went IPO in the last 12 months that don't make any money, that lose all kinds of money. And so, and all of the WeWorks and Ubers and all these other companies with huge private valuations that lose all kinds of money, and are all dependent upon easy flow of cash. And so what we saw in 2000, which was a great capacity binge and then bust, will happen again here. But that doesn't mean the cloud isn't going to continue to grow. So there'll be a great bust, and from that there should be opportunity.
Very interesting. Yeah, I mean, Amazon did what the time to buy Amazon, right, was after the bust, the technology bust, right?
Because it is with all of them. All of them.
Yeah, imagine buying Google or Amazon after the technology bust. Those two companies were actually, created, I believe, during the bust, right?
No, not exactly. Different timing on them, but they weren't very. If they were already there, and I think one of them was, then they were very small. So, but yes, that's you'll get a lot of new names too. That's correct. You'll get companies that we don't know the names of that will be potentially opportunities at the time too.
So last question for technology. So I take it you're not buying any cryptocurrencies even after this crash has continued.
No, I think I don't believe in them. I believe that they're Charles Kindenberger, Manias, Panics, and Crashes, a famous book, wrote about what he called delusive objects, and delusive objects are things that aren't worth much of anything. But at the end of markets, bubble markets, people tend to gravitate to things that are delusive, meaning have no value. And I think that's what these are. They certainly don't exist. There's all sorts of problems with them. I mean, today we saw another theft of $30 million worth of cryptocurrencies in Korea, and one the night before, I think, even larger, or certainly last week. This seems to be a common occurrence. They're not used as a currency, really. There were a bunch of people like Steam, which is the largest gaming online network out there. They used to take Bitcoin, they don't anymore. The valuation fluctuates so greatly, and it takes too long, too much energy, too costly, too much time for transactions to be confirmed. There's all sorts of problems here, none of which are making it money. Money should be a store of value. A store of value should also hold its value during when everything else is going crazy or collapsing, and the classic store of value over time, over 5,000 years, is precious metals, gold and silver. And they do best in times where the market's doing worst, when the economies are doing worst. Well, the cryptocurrencies were flying high along with the tech bubble, and that made me suspect that they were delusive objects. And so far, that seems to be the case because they've been crashing all year long. And that didn't surprise me. If you look at the chart of cryptocurrencies, it looks very similar to tulip bulbs or South Sea bubble, Mississippi bubble. Same kind of pattern on its way down to nothing almost.
I think the gold and the silver stocks are some of the cheapest valuations of any industry and asset class I can find right now. So let's spend the rest of the interview talking about that. When we're recording this interview on Wednesday, June 20th, 2018, we have the dollar index having a rally. The dollar index is above 95 now, mostly due to the problems in Europe. We have the gold price, which is breaking the 1280 support level. So do you think in the short term that the gold in U.S. dollars is going to continue to go down? Or do you think that gold's going to actually have somewhat of a rally then, even in the headwinds of a stronger dollar?
Well, excuse me. I told you this period reminds me of 2000. And it's not just technology stocks that it reminds me of. It reminds me of gold in 2000, when there was absolutely no interest in gold. And as you know, gold soared from $250+ all the way up to $1,900 by 2011. So if you were buying the most hated thing, it was that then. And it's that today as well. And that's just the way it is with, as I mentioned, stores of value and gold. All along here, as we've seen, when we had the 1970s great bull market in gold, well, it was a terrible market for stocks. And a crash in the early 1970s, and we had the oil crises. We had all sorts of problems. The economy was a wreck. Inflation was rising. It was a bad time, and that was the best time for gold. And then the stock market bottomed, early 80s. Reagan came in. We had interest rates slashed from what were the 20% levels, and we had a great bull market that took us all the way for 20 years, all the way to 2000, the 2000 top. And during that 20 years, almost that whole time, gold went into a bear market, and a major bear market. And then in 2000, the market tops. Gold goes on its rampage. Miners go on a bigger rampage, go up 1,600%, and stocks are in the lost decade, including 2 crashes. And so here we are today, where there's absolutely no interest, where we have daily sentiment index, last I looked, in single digits, which you don't see very often, but whenever you do, there's a rally coming. When institutions have a fraction, just a tiny fraction of their portfolios, a fraction of 1% of their portfolios in gold, or it used to be 3, 4, 5, 6% various times, where the futures traders have a very low position, big short, very low long, half of the level they were at the peak in 2016, for example, of their long position. You have almost no buying by the public. Mint sales have been ridiculously low all year. So no interest. And that's what it was in 2002, right before they all took off. So it feels like deja vu all over again in every way. The miners being, and the metals being where they were then, and where they are now. And tech stocks where they were then and where they are now. And it's unfortunate that this is the case, but you have to take advantage of those situations. So I look upon this as a great opportunity. Now, I think the gold market bottomed at 1050 in December of 2015. And we're up, $200 from that point. And I'll be surprised, very surprised, if we were to go and break that level. I'd be shocked. One of the reasons is the cost of production is pretty high, and as it is, you have no exploration going on. Capital spending has been cut back, and people are talking about peak gold, and so I think that was the bottom, and we're in the process of going back and forth with big rallies and then sell-offs, but 2 steps forward, 1 step back. And we've seen this series of higher highs and higher lows. And I think what you need is to break out of that 1365 level, and you're going to bring a lot of interest into the market. And that will likely happen around the same time that the tech bubble breaks, whenever that is. And so here we are. The Huey to gold ratio is at 0.13, and that's the gold stocks to gold ratio, and it was at 0.13 in 2000. Versus an average of 0.35, and when things really got going in the mid-2000s, it was 0.65. So you can see why they went up so much when their earnings went up a lot, when the gold price roared, but also the valuations that they were given were far better. Today, they're given rock bottom levels, 2000 levels. So I made a lot of money in the 2000s in the metals market because I knew at that time, I believed, that tech would be in a long-term secular bear market, and it was, and it would underperform, and it did. So here we are again, where I get another bite of the apple at the same kind of valuation levels. Only this time, we have $4 trillion printed by $4 trillion printed by the Fed. We have nearly $6 trillion now. Printed by the ECB and everyone else. Just unfathomable amounts of money that's been, and that means to me debasement. That means when you print all this money, it means that you're debasing it at just a rate that we've never seen in this country. We've seen hyperinflations before, but I guess 57 of them around the world, but never here. And so we have this massive debasement. I mean, gold has always gone up against the dollar anyways. It's up 95% since the Fed has been established. It goes up because there's constant debasement and inflation. So relative to the dollar always falls except for brief periods where it rallies. Now, in the 2000s time frame, dollar rallied here and there. Not all the time. It wasn't always down. But the gold went up every single year. Gold should go up against all currencies that are being debased, and all currencies are being debased. So the fact that the dollar is up a little bit this year after getting bashed last year, I don't see that as anything but temporary. Now, one of the big correlations that you have, one of the best correlations with gold that you have, is deficits. And when I said the gold had bottomed in 2000, we were running surpluses in this country. Since I think 1998, 1999 into the early 2000s, we were running surpluses, and the Treasury was trying to figure out what they would do with all of the money that they were going to be that was going to be coming into their coffers when they didn't have any debt to pay down. Now that was the case. That was what they were thinking, and it turned that was the thought. And deficits started to grow after 9/11, particularly. And then when we had the crash during the Obama years, we had massive deficit spending, and that just kept going. And as the deficits grew, so did gold, all the way into 2011. And what happened then? Sequestration happened then, and the deficits as a percentage of GDP started to decline. And as those deficits as a percentage of GDP declined, so did gold. And it had I like to say, a mid-cycle correction, because I believe that the real bull market began in 2000. But and this is a mid-cycle correction, sort of like we saw in the mid-70s. But the deficits as a percentage of GDP declined until 2015, when they started rising again. And what happened then? Gold bottomed. And that's one of the reasons why I think 1050 was the bottom. And since that time, deficits are only getting larger and larger and now larger, and the CBO is now talking about $1 trillion plus kinds of deficits. I mean, the latest monthly number was up 25% year over year, right? Now, that's without considering recessions. Now, when recessions occur, you have massive increases in spending. All of the welfare and unemployment costs, all of those costs go soaring. Now, we went to 1.4 trillion in the 2009 recession. We're going to go to 2 trillion, and we're heading in that direction. With all of the Trump tax cuts, and at the same time, we're spending more, which is insane because we never had deficits. In the past, you would either bring your deficits way down during economic rebounds or eliminate them. And now we have these humongous deficits starting point. We're cutting taxes and we're raising spending at the top after 9+ years of an economic recovery as weak as it's been, but still at the top. And they haven't outlawed recessions, even though people seem to think that. And if you see what's going on around the world, you see this trade war ratcheting higher. That's not good. That's not good for world economic growth. And around the world, the only stock market that's really doing well now is the U.S. stock market because the Vanguard Total World Index dropped to a 7-month low yesterday. And that's because of concerns over world trade declining. And then factor in the higher interest rates and pulling back on QT, meaning reducing the amounts on the Fed's balance sheet by now $40 billion a month and $50 billion starting in the fourth quarter. So what really propelled the market higher and got us out of the downturn was not lower rates, it didn't work, but it was all that QE. And it propelled these stocks to these ridiculous levels that we talked about, and now they're pulling back. Well, if you raise interest rates, and historically you're almost always going to get a recession, yet the CBO doesn't consider a recession, nor does the Trump administration, and they never do. But what I'm saying is we're going to have a recession. They're raising rates. QT is ratcheting higher. The ECB, in theory at least, is supposed to stop. It's certainly cutting back. And the record amounts of QE that we had, even through last year, because the others were taking up the slack when the Fed had stopped, is now going in the other direction. So the market will break first. I don't know exactly when that'll be, and that will lead to recession. That's the sequence of events. And when that happens, your trade deficits go to the moon. And what does gold do when that happens? It goes higher, a lot higher.
Yeah,
so that's why I think that we're still in this bull market. And the next phase of it began in December of 2015, and why it's going higher.
Yeah, I agree. Something will break. It's a question of when and not if. It's just timing's going to be the tricky part. I mean, if the dollar continues to strengthen too, that could collapse emerging markets. A stronger dollar will cause a lot of problems worldwide as well.
Well, yes. I mean, we're not talking about if the dollar. We're already seeing these crack. We're seeing Argentina and Turkey. Remember, in the 1997, 1998 timeframe, it started with Thailand, tiny Thailand, and then it spread contagiously. Now here we have multiple emerging currencies that are in trouble, from Turkey to Argentina to Brazil to you name it, and they're all cracking already. But of course, people ignore the warning signs, and that's just one of them. So if you put it all together, we have reduced QT, we eliminated QE, and now we've gone to quantitative tapering. We have rising interest rates on the greatest debt bubble we've ever seen. We have $65 trillion of debt in the U.S. alone, and 200 and something trillion dollars over the world, which is up 50% from where it was in 2008. We have oil prices that are rising. We have a dollar that's rising, which is causing a lot of this emerging market problem, but also causing a problem for technology companies. And you add all of that up, and what you're going to get is you're going to get a market decline, a big one. So, that's what we're facing. But just as in, the top in the NASDAQ in 2000 was March of 10th. I remember it well. The day before was crazy. There was no sense that the market was going to break. None. There was no major trigger. Now, you can point to things. The Fed had been raising rates a little bit back then. You can point to things. Valuations were insane, well, as they are today. The Fed's raising rates as they are today. But there's no particular trigger for March 10th, 2000. It just blew up. It just ended. They ran out of money. And no one knows when that is. So all you can do is prepare. Get yourself in position and be ready.
Yes, and to add to your points there about the budget deficits with President Trump, I mean, it seems to me he's using this supply-side economics playbook. The difference between what Ronald Reagan did and Paul Craig Roberts and other people in the Treasury Department back then was the debt to GDP ratio was below 40% back then.
Yeah. Yeah, and we're talking 125%, assuming no recessions, right? Which is not going to happen.
So I don't see supply-side economics working. I see, at best case scenario for me, in my opinion, is worse stagflation coming, especially with trade wars, because if we have retaliatory tariffs, that's going to force higher and higher costs throughout the global supply chain. And you use the word if. It's not a matter of if now, okay? At the beginning of the year, it was if. Now we have tariffs against virtually, I mean, all at once even. This is just blows my mind. Let's go after all of Europe, Mexico, Canada, all our allies, Japan, and China. The two largest economies are currently trading and ratcheting up tariffs as we speak and threatening. So this isn't just something that might happen. This is something that is happening right now. And it's not theoretical any longer. And Donald Trump said that trade wars are easy and they can be fun. Well, no, the world economy never wins in these things, and we have the two largest economies of the world going at each other, and us ratcheting up tariffs against everyone else as well at the same time. That's a recipe for 1930s. Yeah, I see Smoot-Hawley. I see reminiscences of Smoot-Hawley. President Trump, I think, is saying some of that stuff for hyperbole. I don't know if he believes all the stuff he actually says. Yeah, he does. He does. Because he's had opportunities to back off. Look at today. They think that they're in the catbird seat. Well, they're not in the catbird seat here. We have a stock market bubble. The Chinese know we have a stock market bubble. The Chinese don't have a stock market bubble. Their bubble broke already. He thinks that China's the one at most risk. Well, maybe, maybe not. I don't think so. I don't think so, and so he thinks this is going to be easy. It's going to win. And he keeps pushing and pushing. So it's always more, and he does it. He was supposedly this weekend. He was put out when the Chinese came back as aggressively as they did with their retaliatory response. And so he ratcheted it up again. Now this is not someone who's trying to make the art of the deal. This is real trade war, and neither side is going to back down. It doesn't appear that way if you read what's going on. You hear what's going on in both China and as well as in the U.S. And there's a lot of people. There's a lot of people, including radio show and TV show hosts and everything, that are really pushing Trump, and his ratings are going higher the more he pushes this. So it's a scary, scary development. And that was one of the things that concerned me about Trump being president. And I thought there were some positives too, but I was concerned about a trade war, and I'm seeing it. And it's happening. Yeah, when Trump was campaigning, he was talking about that he was going to do it, and how long he had been talking about tariffs and trade war. That was one of the things about him that worried me the most as well. Yes, and it was one of his core beliefs in his platform that he would do this, and he has. He's saying what he was going to do. So the hope that he's not going to continue doing it is just not very likely. This is only going to get worse, as it has. It has only gotten worse until something blows up. So Fred, switching back to gold and gold stocks as we wrap up the interview here, last couple thoughts on gold and gold stocks. So if I could add to some of your comments on that, I think from the comment section, I think we're extreme negative sentiment. This is anecdotal, obviously, but the videos I put out where I interview experts and they actually say nice things about gold and silver now, the comment section is just predominantly negative. So, and those are U.S. retail, Canadian retail investors. They don't want to hear anything good about gold. So, well, yes, gold itself is in great demand around the world. The Chinese can't get enough of it. They have an ETF, their largest ETF, that is up 3,000% in its amount that they put in it over the last year. Okay, in Europe, there's huge demand. The Zetra ETF is up big as well. Obviously, India continues to buy, and Russia buys at least 200 tons every year. And you saw they dropped their U.S. treasuries by 50% here. There is great demand for gold everywhere except for in the U.S., Western demand. But
The gold stocks that we talk about, you know, the Newmonts, the Barracks, the Gold Corps, and all of those kinds of stocks, those are U.S.-based traded companies. The Chinese don't buy those. The Russians don't buy those. The Indians don't buy those. So that's one of the reasons why they're so egregiously underpriced.
Well, I would also add too, Fred, that I've been researching and covering gold stocks for a very long time. I've got contacts in the industry. I know you spend a lot of time looking through annual reports, quarterly reports, listening to conference calls. I would say the majority of gold stocks and silver stocks are extremely poorly run. There was a ton, tens of billions of dollars in bad deals. The CEOs of many of the gold miners bought deals, you know, at the top. They bought high and sold low. We had, I think, according to Hathaway, the fund manager. Well, one of the Hathaways, I forget. He's over $80 billion in write-offs for the gold mining industry. So people have to be very careful which gold stocks they buy.
I'm going to correct you on something here, though. Okay.
Sure.
You should use the word they were poorly managed, because but the managements have been turned over. There's 60 or so, scores of CEOs and CFOs that are gone. And over the last few years, they have taken their costs down. The new management teams have taken their costs down on average. They're all in sustaining cost, AISC, by 25%, which is they've reduced their debt levels. They haven't made bad deals. Those people that did it, for the most part, there's a couple that are still there, but for the most part, those people are all gone. And I can tell you there was a lot of wasted money in the tech bubble, too, because they are the ones that poured in all that money into all of their excess capacity, and they're the ones that lent to companies that were going to go bankrupt. And today, what are they doing? They're pouring their money buying Apple, using all their cash that they may have purchased over the year, or that they may have earned over the years, to buying $900 billion stock valuations that are going to implode, just as IBM, the horrible management there, did when they were buying in the 200s, and it's 144 now. They are destroying capital, just as so many managements do at tops. And I'm not so sure the gold company managements were any worse than what I've seen in tech. And this group here, because they saw what happened, because they've been so battered, I hear these CEOs, and they say they go to these gold conferences and they can't fill out their schedules. There's no investment managers even interested in looking at them. And they know why that is, because there were a lot of bad deals down at the top. There was a lot of money destroyed. But it isn't just the gold area that's where we saw that in spades in tech and in other areas as well. And we'll see it again in tech. We'll be recognized. They're doing it right now. It'll be recognized as such. So that was the past. Now we have people like Burack's CEO, who is from Goldman Sachs, and they're not doing any deals of significance. They've been selling off the bad deals that the prior management had done. They've been slashing their debt. The insiders have been buying like mad. Contrast to tech, where it's a sell-a-thon, where there's $5 billion sold in the first half of this year. But insider buying, including 300,000 shares by the CEO alone just a few weeks ago. I mean, the chairman, Thornton, from Goldman Sachs, the CEO also bought shares, the CFO also bought shares, and all sorts of other people, and they're buying a lot. They're buying shares because they recognize how cheap these stocks are. And so these managements are doing what I would want them to do. And so I don't want to brush these people with the same brush that you could have with the ones that were making the bad deals at the top. And that's a distinction that investors have not made yet, but they will. And that's just one example. Like I said, the whole industry has brought their costs down. The whole industry has brought their debts down. They've not seen the kinds of deals that you saw. You've hardly seen any. And if they are, they're pretty good deals because they're taking advantage of the very low prices, not buying things at top.
I think that's a good sign that insiders are putting their money where their mouth is and actually going out in the open market and buying large amounts of stock because, nowadays that's extremely rare.
It is. And there's a lot of these
compensation and financial engineering and share buybacks with debt. It's very rare.
Because remember, these companies, these insiders are all getting options as well. They're going out and paying additional amounts, right? Mm-hmm. So you're talking John Thorne's case, 300,000 shares, and Barrick's a $13 stock. That's a lot of money. And many of these other people, 10,000, 40,000. You see it all the time. And it's across the board. There's a whole bunch of insider buying that's going on across the board of these gold stock companies, in addition to the options that they get. And, that's one of the strongest statements that I think that can be made.
So what other gold stocks do you think are interesting? I know on Twitter you talk a lot about New Gold. So New Gold had problems with a new mine, and they seem to have fixed those problems with Rainy River.
Yeah, okay. Well, New Gold let me start off by saying I try to narrow I screen gold stocks, and one of the top screens I have is where is it located these days, because much of the world is not safe. And I think if the gold price goes up as much as I think it will here in the next few years, all of these governments that are so indebted in different parts of the world are going to try to go after them, as they're doing already. We're seeing, in Congo and Mali and you name it, all of these places are ratcheting up royalty rates and taxes, and in Indonesia, it's terrible. So New Gold was a company that had very great location. It was their mines were in the U.S., Australia, and in Canada primarily. And so that was attractive to me. And they had a strong management, and they had a good track record. And with their New Afton major mine, flagship mine, they had bringing it up on time, on budget, all of that. So it looked like it was going to work well. They had a new mine called Rainy River in Ontario, and when it came online, it was going to almost double the size of the company. And they've struggled with that. And they had a change out of the CEO in early 2017. And most discouragingly, after the comment you made about what I had said, which is true, the second CEO, the new CEO, also got turned out, which made New Gold to me be kind of dead money until they can prove the problems with the startup of Rainy River aren't serious. And that's going to take time. So I had cut my position back quite a bit here in the last couple of months in New Gold until I get some sense that Rainy River is under control, and they have new management there. So, but we won't know. We won't know for some months. So I consider it to be dead money. I think we usually get a seasonal turn in gold that usually begins either late June or early July. I mean, not early July, sometime in July, because of the type of buyers that we have from India and China and elsewhere in the seasons. And so I wanted to be in things that were going to do better, and so I moved a lot of my money elsewhere. Now, I mentioned Barrick. I think that they've done a lot of things right. I really like that one. My favorite management of all is Agnico Eagle Mines, AEM. And they did a great job. They did not overextend themselves like so many managements did, and that management is intact, as it should be. And they actually took advantage of the low prices when they were most low a couple of years back, and made some great acquisitions at distressed prices. And as a result of that, they have a very strong portfolio of assets that will give them a growth rate going forward, not this year, but starting in 2019 and going forward. This is sort of a transition year because they're bringing on two mines in Canada. Again, their locations are just great. They purposely stay out of all difficult countries and around the world where they may have some geopolitical issues. So their locations are mostly in Canada, and they have some in Mexico, and they have a big mine in Finland. And so they've done a great job, always looking to the future, always looking long term, and they're going to see a ratcheting up of their growth rate starting in next year. And the mines that they're bringing in are going to be high-grade mines, and they're going to be lowering the cost as a result of that. And they've done a good job lowering the cost during this difficult period as well. So I think they've just done everything right. They didn't do anything wrong, unlike many of the others at the top in the late 2000s. So I really like Agnico Eagle. I like Goldcorp. longtime CFO of Agnico, is now running it, and he's again done much similar things to what Burack has done in reducing their debts, slashing costs, $250 million program to cut costs. Most of those have already occurred. So bringing down their costs, bringing up the profitability, and they all too will have growth once their flagship mine, which is in a down cycle at the moment because they're stripping, once that comes in, that should start to improve at the end of this year into early next year as well. So I like Goldcorp. I really like Kirkland Lake, but it's I bought it a year ago at 6 and change, and it's 20. So I really like that one because it's performed in an outrageously bad environment. But they have two fantastic mines with very high grades, where they continue to find high grades. Last year, their Fosterville discoveries from drilling were the best of all, any of the miners. So I like that one quite a bit. It's up quite a bit, but I think it could go a lot higher. And there's others. Alamos, another company where we've seen tremendous amounts of insider buying. Made a very good acquisition in what's called Richemont, their island mine, and they've been getting great drill results as well from that. And I think that's the reason why you're seeing all of this insider buying. So those are just some of the names. But again, all of them are going to be in safer locations. They might have some exposure to weaker areas, but even in Burack's case, all of their prospective projects and mines are pretty much in Nevada and Canada. That's where they're putting all their focus right now.
Thanks for sharing that. Great insights. Yeah, I think if the gold price continues to have a little bit of a correction here in the short term before maybe it starts a big rally again, I think the 5 larger precious metals royalty and streaming companies, those guys are going to do a lot of deals too. So, you talked about bucking the trend with Kirkland Lake, the success the share price has done. Not many gold stocks have had huge share price runs, but the gold and silver royalty and streaming companies, if you go back, 4 or 5 years, Franco-Nevada is up in the last 5 years about 70%. They've been a solid, I think they have the largest dividend now of any company.
Yes.
They have like about...
I actually own that one.
Yeah, but Franco doesn't mine though, so we can't. They're
not a miner. No, they're a royalty streaming company. Yes.
Yeah, the royalty streaming model is more just like publicly traded private equity. So it's like a team of, they have a couple geologists maybe, and they just do deals.
Yes, I know. It's been a great model, and the companies have done well, and they've been well managed. I do say this: they're very expensive. So if you get a big rebound in these very undervalued gold miners that actually produce, you're going to get a big kick from that. Like I said, you saw, well, even in coming out of the 2015 bottom, we went up 160% in 6 months on the gold stocks, and in the 2000s time frame, they went up 1,600+%. So, and in the 1970s, I went back and looked at all of those, and they all went up by 10 times or more. And I don't think that can be the case in these. You're not going to see that because they're already relatively kind of expensive because they've done well. Even in the 1930s, we talked about trade wars and all of that. Smoon Hawley, the two of the best performing stocks were Homestake mining, the largest gold stock, and Dome mining. So they do well in times of trouble, and they do particularly well when they're really depressed. So I'd favor the producers over the streaming royalty people just because of valuation and what you can get out of these. The potential is huge.
And the other thing I would say right now about the current gold and silver price, and given the industry, and also with this trend, which I think is a bubble in ETFs and passive investing, is from my contacts, I'm friends with Nolan Watson of Sandstorm Gold. A lot of these junior explorers that actually go out there and do the drilling and try to find the mines, 10 years, up until about 7 or 8 years ago, they could have easily raised private placements or bought deal financing from investment banks and merchant banks. That capital is not really there anymore.
Yes, and that's correct. Pierre Lassonde and others in the industry are all saying the same thing. It isn't there, and so the only place to go has been to these royalty streaming companies. They're the only ones. The money is very tight, and that's one of the reasons why you're not seeing any large discoveries at all, and why people are talking so much about peak gold.
Well, I think also, the larger senior miners and some of the mid-tiers can be strategic and go and do really quality deals with some of these juniors and put a little bit of money at risk, maybe a couple $1,000,000. And if the drill results turn out, they could have bought, access to a very large mine for a very small amount of money. So the royalty and streaming companies and the larger miners that are doing this, long-term, they're going to be better off for it.
Yes, absolutely. I agree.
Okay, Fred. Well, I think I've kept you long enough. It's over an hour. You gave my listeners an absolutely fantastic interview with great insights. If my listeners want to follow more of your work, how do they do so?
Okay, well, there's two ways. One is subscribing to the newsletter, which has been we've been in business for 31 years, our 32nd year now. Anybody's interested in doing that, send an email to the High-Tech Strategist at yahoo.com. I'll spell it THEHIGH, strategist as it's spelled, at yahoo.com. And or in addition, I'm also on Twitter, where I put out some information, limited, some thoughts as the in between newsletters.
Yes, I remember we got in a little debate about New Gold a while ago. So.
Oh, is that right? Yeah.
Yeah. I was. You were. I think this was about a year ago. I think you were more bullish on them than I was.
I
was like, this was before they brought in the second CEO. So
right.
I mean, obviously, you would change your opinion based on the facts. I agree with you. I think there's more red flags there now.
There certainly are, and so you did well. I did not.
well, I wasn't sure. I wasn't shorting New Gold, so
okay.
I don't short.
Well, you did well by not being in it. I didn't because I was in it. So, oh well, you're not going to hit them all. You got to just do your best, and over time, I've done very well. So.
Yeah, I agree. I bought New Gold years ago. I think not too long after the 2008 financial crash. I think
right.
I bought it for $2 or $3 a share, and I sold it at like $8.
Well, then you did really, really well. Yes.
Yeah, I did pretty good, but back then it was a lot easier to make money on gold stocks.
Yeah, that's for sure. That's the understatement of the year right there. That was so great about Kirkland here to actually have such a large winner, and it was the largest winner over the past year and last year. So it helped the portfolio quite a bit.
Yeah, there's been a handful of gold stocks that have bucked the trend, but we'll have to see. Overall, like I don't know about what your opinion on this is, but I don't think the gold and silver prices are going to go that much lower because I don't think overall primary gold miners and primary silver miners can really cut that many more costs. So I think. I also think
that we typically have seen these bottoms occur at quarter ends. So we talk about December 2015, December 2016, June's. We've been seeing our bottoms occur around that time frame, and that just so happens to be seasonally the strength. If you go out of June and July, with all the Indian buying and the seasons and the wedding seasons and harvest season and obviously Chinese New Year and all of that, so you're going to have a tailwind anyway seasonally coming out of that. But also we've seen the traders have their lowest positions at the end of the quarters, and then they rebuy following the quarter. So I'm hopeful that possibly we'll get a bottom within 10 days or so.
Yeah, I mean, like the technical analysis people, some of them for gold, think that there's not support until 1210. But I mean, around those levels, a lot of primary gold miners, the higher cost ones, they're not going to have much margin. So I think there's going to start to be supply problems around those levels. But I want to thank you for your time today, Fred. And I really enjoyed, getting to learn more about the technology industry and your insights on the gold market.
I wish I could have been more positive, but it is where we are. So.
Well, I think honesty and actually saying what reality is more important than sugarcoating it, because if people want sugarcoating, they can just watch Bloomberg or CNBC. Yes.
Okay. Very good.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, If you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.